Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. In many competitive industries, companies are not all competing the same way. Some focus on offering the lowest prices, others aim to create unique products, while some go after broad markets and others target specific niches. Even though these companies operate in the same industry, they often use very different strategies. Strategic group analysis helps us understand these differences by grouping firms based on similarities in how they compete, their structure, and their market position. This approach goes beyond looking at the industry as a whole and helps managers see which competitors are the closest threats, which operate in different spaces, and where there might be chances for a company to shift its strategy. In this presentation, we'll explore what strategic group analysis is, why it's useful, how to do it, and look at real examples along with its strengths and weaknesses. The images here, including the strategic group map, visually represent how brands can be positioned differently based on key factors, helping to clarify where each stands in relation to others. A strategic group consists of firms within the same industry that use similar strategies or compete on similar factors like price, product quality, geographic reach, or technology. This idea helps explain why companies within the same industry often perform very differently. Firms in a strategic group tend to face comparable opportunities and threats, compete more directly with each other, and have similar cost structures. We often use strategic group maps to visualize this by plotting companies along two important dimensions, which highlights clusters of competitors and uncovers potential market gaps. From a practical standpoint, strategic group analysis is valuable because it helps managers focus on their most relevant competitors instead of treating the entire industry as one thing. It aids strategic planning by clarifying which moves might trigger retaliation within a group and which won't. It also improves risk assessment since different groups face different economic or regulatory challenges. Lastly, it helps with decisions about entering markets or repositioning by revealing crowded areas to avoid and underserved segments to target, giving firms a clearer picture of the risks and opportunities involved in shifting between groups. To conduct a strategic group analysis, begin by clearly defining the industry scope to ensure the firms included operate in similar markets and compete for related customer needs, avoiding definitions that are either too broad or too narrow. Next, identify the key competitive dimensions that differentiate firms, such as price or quality level, product range, geographic coverage, distribution channels, vertical integration, and brand positioning, choosing those that significantly influence customer choices. Then select two key dimensions that are independent, measurable, and strategically relevant to create a clear map, often using examples like price and product range. After that, plot each firm on a strategic group map based on their position along these dimensions. Clusters of firms indicate strategic groups, and circle size can represent factors such as revenue or market share. Finally, once the groups are defined, analyze them by assessing the intensity of rivalry both within and between these groups to gain insights into the competitive dynamics of the industry. Entry and mobility barriers are important because they influence how easily firms can move between different strategic groups within an industry. These barriers include factors like brand reputation, cost structures, capital needs, technology, or organizational skills. When these barriers are high, they stabilize the groups and protect the firms already in those positions. When barriers are low, competition between groups becomes more fluid and intense. Understanding these barriers helps firms decide if it's possible or too costly to change their strategic positioning. For example, in the airline industry, we see distinct groups like low-cost carriers that focus heavily on price and asset use, while full-service airlines compete on service quality and brand prestige. The automotive industry also shows clear groups based on market segments such as economy, premium, and luxury, with strong brand perceptions limiting movement between them. In banking, traditional branch-based banks, digital challengers, and niche players form different groups, each with unique customer bases and cost structures. These examples highlight how strategic group analysis, considering mobility barriers, shapes our understanding of competition and opportunities within industries. Strategic group analysis offers several practical benefits. It helps us focus on direct competitors by grouping firms with similar strategies, which makes competitor analysis more targeted. It also reveals differences in industry structure that might not be obvious from just looking at the market as a whole. This approach assists in predicting how competitors might react to strategic moves, supporting clearer positioning and differentiation efforts. It can identify gaps in the market where opportunities for repositioning exist, and it helps explain why some firms perform better than others within the same industry. Because of these benefits, strategic group analysis works well alongside broader tools like Porter's 5 Forces. However, there are limitations to keep in mind. The way groups are identified can be subjective, depending on the criteria chosen, and different analysts might create different groupings based on their perspective or data. The analysis captures a single moment in time, but industries evolve quickly, and firms can shift strategies, blurring group boundaries. There's also a risk that focusing too narrowly on these groups might cause managers to overlook emerging threats from new entrants that don't fit existing categories. Lastly, while strategic group analysis shows patterns, it doesn't explain why performance varies or guarantee specific outcomes. In practice, the most effective use of this tool is as part of a broader strategic toolkit, combining it with internal capability assessments, customer segmentation, and environmental scanning provides richer insight for decision-making. Managers should use strategic groups as flexible guides rather than fixed categories and revisit their analysis regularly to reflect changing market conditions. Strategic group analysis helps organizations see the competitive landscape more clearly by grouping firms with similar strategies and looking at the barriers that keep them apart. This approach offers valuable insights into how rivalry, opportunities, and risks play out within industries. Although it's important to apply this framework carefully and recognize its limits, it moves us beyond the simple idea that all competitors are the same. In markets that change quickly and are complex, this tool helps companies focus on the areas that matter most, making strategic decisions more informed and effective. When used alongside other tools, strategic group analysis remains a practical and relevant way to understand competition and build lasting advantage. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.